In this lecture, we're going to be talking about trend lines, channels, supports, and resistances. So if you've done my other cryptocurrency investment course, you've already went through this material, but I want to go over it again a bit because I want to pound in some more advanced ways of looking at it. And when we get into the strategy section, we are going to apply it in a bit of a different way. Okay, so trend lines. What are trend lines? Or trends actually. So trends are basically a direction that a cryptocurrency is going to take, or that any financial product is going to take. So anything, and I'm going to say cryptocurrencies for now, are going to go either in an uptrend, a side trend, or a downtrend. That's the only way they can go. Okay, there's no other ways. So an uptrend is when the prices are going up. And how is that characterized? It's characterized by having higher highs and higher lows. So you see here we have a low, then we have a high, then we have a low, so prices are going down, but the low is higher than the previous low. Then it's going back up, the high is higher than the previous high. Going back down, the low is higher than the previous low. So things don't just keep going up. They go up, down, up, down, up, down. But if every time they're going down, the low is higher than the previous low and the high is higher than the previous high, we're going in the upwards direction in general. So we say it's going in an uptrend. If it's going sideways, so the lows are at equal, prices than each other, and the highs are at equal distances from each other, then we say it's going sideways, it's trading in a range. And then if it's going down, we say it's a downtrend. So a downtrend is going to have lower lows and lower highs as well. Okay. And when something is going in a direction, it has, some type of momentum. And this is why you hear the saying, the trend is your friend, or don't go against the trend. Why? Because when something is going in a direction, you have to understand, think about it as, let's say, a train that's going in a direction. If you want to stop this train, you need a force that's equal or larger than the force that it's going at right now for it to either slow down or go in the opposite direction. And it's the same thing. If buyers are always a bit more aggressive than sellers and they're pushing prices higher because there's more of them, and then when sellers are selling, buyers are coming in and buying at higher prices and pushing it back up, then there's some type of momentum. And we're going to require a lot of sellers to come in to stop that momentum and for the prices to reverse. So because of this, trends are very important because they tell us the direction that we want to go in. Because we don't want to go in the opposite direction of where the cryptocurrency is going, right? That's just common sense. So when we're looking at trends, what we're usually going to do is we're going to draw a trend line. So if you're seeing prices are going up, what you're going to do is basically you're just going to take, let's see, I'm going to take my pen here, and you're going to be like, okay, it's going up. I'm going to draw a trend line here, just connecting these dots. So this trend line is going to tell me that, it's just going to show me that the direction of the prices. Okay. So you're just going to draw a line that connects the bottoms. Now, what you're going to end up seeing is that prices are going to be, or that this trend line is going to support the prices. Now, why is that? Why is this trend line going to support prices? Is it because prices are going in the upward direction and the line just causes us to visualize it? Or is it the line that actually causes the prices to bounce off of it? I think it's a little bit of both, right? Everybody knows about trends. Everybody knows about trend lines. So the fact that we're putting a trend here and saying, well, you know what? Prices are going to bounce off of it because it's a support line. Then what's going to happen is everybody who's wanting to buy this cryptocurrency, they're not going to start buying it at this price. They're going to buy it when it touches the support line or this trend line. Why? Because they know it's going to bounce off of it. So then you have a lot of people placing orders to buy. And when these people place orders to buy, like we've seen on the order book, there's going to be a lot of people on the order book at that price. And because there's so many people there, the price is going to have a hard time breaking through it. And it's not going to go below that price. And so the price is going to bounce off of this trend line and go back up. So it's like a self-fulfilling prophecy. If we tell everybody, hey, this is a great place to buy because the price is not going to go below it, and then everybody sends orders to buy there, and then the price doesn't go below it because of these people, then it's a self-fulfilling prophecy, right? We made it happen because we said so. So it's kind of both. It's like people are exacerbating this thing, but there's also some truth to it that, when things go in a direction, there's more likelihood. It makes sense that they keep going in that direction, right? So you're usually going to draw a trend line to show you the direction, but also to be used as a support for prices. Okay. Now, when the trend line breaks, usually what's going to happen is everybody who was looking at the trend line or who was long, who wanted to buy to make money for it going up, they might start selling. And people who wanted to buy might not buy anymore. And what's going to happen? Then there's going to be more supply than demand. And because of that, prices are going to end up going down and reversing. So when a trend line breaks, there's a high likelihood that we go in the opposite direction. Now, trend lines, you can draw two of them. You can draw one at the bottom, one at the top. Like if I go back here, I can draw another trend line here. Sorry for my, this is really bad. So you have two lines. Why? Because like we've said, things are going to go up, down, up, down, up, down. So prices aren't just going to go in a direction, but they're going to go in channels. Okay. Prices are going to be fluctuating in channels. So we draw one line below the prices and one line above. And this one, the one below, we call it support. The one above, we call it resistance. Why? Because the one below is going to support prices. And the one above is going to be a resistance for prices. Okay. Now, if you're trading something like this and you want to make money off of it, what are you going to do? Are you going to buy here and then short here? No, you're never going to short because it's going upward. So you're only going to go long. Now, when will you buy? If somebody isn't looking at these channels, somebody might buy here. Imagine somebody who buys here and then sells, I don't know, here. Well, how much money did he make? He made this much money. And in how much time? Well, in all of this time. Now, if you're a good trader, what you might have done is buy here and sold here. So you made more money than this guy. And then when prices go back down, then you buy again here and you sell back again here. So you made this much money again. And then when prices go down, then you buy again here and you sell again here. And then you made this much money again. So, So you've made way more money, okay? You've made way more money. And you weren't using your capital all the time. So your capital was available sometimes. So you might have made other trades simultaneously. And that's the idea of technical analysis. The idea of technical analysis is not just to tell you when, if you want to buy something or sell something, but to get good entry points and exit points and to systematize your trading. So you might trade based on something completely different. You might look at only fundamentals and look at the team or projects or something, a strategy that you've developed. But you're using technical analysis to give you a systematic way of trading that you can reproduce and maximize your returns. So a few things about supports and resistances. You're going to see supports and resistance in trends. So when things are going in a direction, you're also going to see them around round numbers. So if, let's say, Bitcoin is going to $10,000 or around it, let's say Bitcoin is at 9,000 and going up, well, there's going to be a huge resistance at $10,000. Why? Because it's a round number, and you're going to see that there's a lot of people buying at that or selling at that price. If we're going from below, you're going to see a lot of sellers here because a lot of people send orders at round numbers. And we've seen that when we looked at the order book in one of the previous lectures, where at a round number, there's a lot of buyers or sellers, depending if we're above that price, there's going to be a lot of buyers below, or if we're below that price, there's going to be a lot of sellers above. And we've seen that on the order book. And what's that's going to do? It's going to cause a support or resistance at that price. So whenever you're looking at support or resistance, understand that they're all coming from the order book. It's all based on transactions that are happening. Okay. And then there's a property for supports and resistance is that they reverse roll. So the roll reversal property is basically that when there's a support that breaks, it becomes a resistance. And when there's a resistance that breaks, it becomes a support. And it makes sense if prices are going, if Bitcoin prices are below 10K and finally they're breaking 10K, before they break 10K, everybody's like, oh, well, it's going to get to 10K. Some people are going to sell. it's, you know, nobody wants to buy at 10K because they're scared it goes down. But if it breaks, okay, and a lot of buyers come in and it breaks and it goes up all the way to 14,000. Now, guess what? If prices go back to 10, then everybody who didn't want to buy, now they're buying because they're looking at the 14K and they're like, damn, it could go back to 14K. 10K is now all of a sudden a good price. So I want to send orders to buy at 10K. And then everybody's sending orders to buy at 10K. And then then the price is supported because there's so many orders there and we'll bounce back off of it. Okay. So if you're going to be using something, well, you are going to be using TradingView to do your chart analysis, you can draw supports, resistance on any charts. You can click any charts you want. You can do it on any time frame as well. So I can go, let's say, I don't know, 4 hours. I can look at something like this and be like, well, you know what? This right now is pretty much in a downtrend. So I can click here on this line and I can, let me just put this a bit lower. And I can be like, okay, well, this is in a downtrend right now. And this is the channel that it's in. And I don't want to trade this at this moment, or I don't want to buy this at this moment because it does not look like like it's going in the right direction, okay? So I wouldn't want to be long in this position, right? Maybe if I think that this coin, so Tron, I'm looking at right now, if I think Tron is a really good coin and there's an event coming up and it's going to do great, well, you know what? Let me time my entry. Let me not buy it right now. Because if I buy it right now, there's a very high likelihood that it comes here, it bounces off the resistance, and then it goes back down. And I don't want that. I don't want that, right? So what I'm going to do, if I really want to get into this position, I'm going to wait until it breaks the resistance, because I know if it breaks the resistance, we have roll reversal property, and then we can go up. So this is how this technical analysis is going to help you. It's going to help you in getting good entry points. So in this situation, you might buy here, expecting it to go up. And if it doesn't go up, you might have a stop loss here and take your loss, but you're not just going to buy at random times. And this is also going to help you because you're going to be trading in the same way every single time. And it's going to be a systematic way that's reproducible and that you are confident in and you are able to do over and over again to generate consistently profitable returns, which is the objective. You don't just want volatile returns. You don't want to have a month where you're making money and a month where you're losing money. Then it becomes too volatile and non-feasible. So that's going to do it for trend lines, channels, supports, and resistance. And I'll see you guys in the next lecture.